Hello, I'm Cameron Kirker, the CIO here at Pitcher Partners Sydney, and I'm here to present our Australian shares outlook as part of our broader economic and market outlook. So, just for starters, this is just a general disclaimer to basically highlight that this is just for general information purposes only. And if you want to seek advice, please speak to your advisor. Now, if we turn to the Australian share market, look, FY26 was quite a wild ride where we saw material strength in the mining sector and sizable weakness elsewhere. And what that actually amounted to at an index level was quite a choppy experience. So decently below sort of longer term averages for the ASX on a total return basis, and also decently below what we saw in international equity markets, where we really lack the same sort of high flyers in AI and tech here. Although we should note that our materials sector shouldn't be downplayed. All this AI investment needs raw commodities to actually build the data centers and to bring these solutions to life. And that's really where some of our miners shine in a material way. The other point to note as well is in previous financial years, the financial sector led by our major banks has been a source of strength. That really hasn't persisted. And if we look at how the sectors performed relative to the broader market, this really brings it to life. The likes of BHP and Rio enjoyed some 60% plus years on a total return basis, where stronger copper prices in particular, near record highs, were a key driver for both of these, as well as lithium in the Rio Tinto case. The energy sector benefited from what we saw in the Middle East, and that really played out for the utilities sector too, where sector heavyweight Origin Energy has that LNG upside from its exposure to East Coast gas. The glaring points of weakness, though, were really in healthcare and the tech sector, where AI disruption concerns really weighed on what have previously been our lead in software stocks. And more broadly speaking, a mix of sort of competition risk and guidance disappointments really weighed on healthcare, with the likes of, sector heavyweight CSL down over 50% on a total return basis. So if we were to look ahead for our outlook, when we break down the ASX into its major sectors, we're still wary on financials, like even with the sort of budget headwinds being posed to them with a slowdown in sort of real estate related lending. Financials still trade at very lofty valuations on an absolute basis, and we particularly see the sector at risk of potential earnings downgrades, depending on how much of a credit growth slowdown we start to see. Materials, we still remain positive. The reality is not just for AI, but also the sort of commodity needs for the energy transition, whether that's renewable energy, so like solar, wind, electric vehicles, and the like. The world needs more copper. It needs more raw materials, and we think our leading miners are in good position to benefit from that. More broadly speaking, consumer discretionary or retail stocks are one area where we're somewhat cautious on, even though we do have the tailwind of a tight labour market. So most people are employed and unemployment's still near record lows, particularly compared to where we were pre-pandemic. And we also have the other tailwind of just ongoing immigration and population growth, which should still support that sector. And lastly, in terms of real estate, we've seen a real stabilization in valuations that has sort of really helped the sector, and sort of renewed interest from institutional investors offshore has also helped stabilize the situation there. And lastly, real estate is positioned as another AI beneficiary, with the likes of Goodman Group in particular, and more recently Centuria, looking to position themselves to build out data center capabilities. So if we were to boil down to what that all means, broadly speaking, we've kept ourselves at a neutral positioning. While we do have reasons to be optimistic on a number of the major sectors, we can't ignore just how big financials are as part of our index, over 30%. And that really gives us pause from considering an overweight posture until we see more certainty in terms of the budget ramifications. And that's why we're happy to sort of maintain a neutral position on the ASX and look forward to the year ahead. Thank you.